Welcome to the deep dive. We are jumping straight into, I think, the single biggest economic tension that defines this moment.
Mm.
It's this fear of an AI investment bubble set against the immense, almost transformative optimism of the computer scientists, the people actually building the technology.
It really is. It's a classic split, between Wall Street and Silicon Valley. The markets are just constantly nervous because the valuations are, well, they're extraordinary.
Yeah. Right.
But the engineers on the ground, they see only unlimited potential.
And they're backing it up with money. Our sources say just 4 major Silicon Valley players are projected to spend an eye-watering $400 billion US.
This year alone.
That figure, $400 billion, it's just stunning. When you see capital expenditure on that scale, your mind it naturally goes back to the last time we saw this kind of frenzy.
The dot-com crash.
Exactly. Are we standing on the precipice of a really painful correction, or are we witnessing the creation of something truly foundational?
And that is precisely the mission for this deep dive. We need to look past the short-term anxieties of the stock market and move into the labs, into the universities. We want to distill the consensus among the actual experts, the builders, to really understand where the real enduring value lies.
So is this .com 2.0, or is it the arrival of the next great utility?
That's the question.
Okay, let's unpack this. We should start with the core technical belief that, I guess, justifies all the spending. I mean, we all use AI every day, right? It's in the background, helping you write better emails, catching spam.
Or generating those incredibly realistic videos you see everywhere.
Right. But when we look at the expert analysis, they say that what we've experienced so far is just the tip of the iceberg. Or to use a better analogy, it's just the test signal.
That analogy is so central to understanding the builder's mindset. There's a computer scientist, Daniel Wigdor from the University of Toronto, who has this brilliant way of framing it. He argues that the current products, like the large chatbots we all interact with, are just very thin and simple demos built on top of incredibly powerful technologies.
So the interface is simple, but the engine underneath it's revolutionary.
Exactly. And the power of that core technology is what we're missing in the public discourse. Wigdor really drives the point home. He says that trying to judge the value of this massive shift by the current apps is, well, it's almost like trying to judge the value of electricity when the only use of it that you see is a blinking light.
Wow, that is a powerful distinction.
Isn't it?
Because electricity, when it was first introduced, it wasn't immediately obvious how it would change everything. It didn't just create a new light bulb company.
No. It rewrote the entire manufacturing playbook. It created the modern factory urban infrastructure, whole new industries.
And that's the key takeaway here. The independent tech analyst Benedict Evans, he echoes this foundational sentiment.
He does. He compares the current jump in capability to the arrival of other general-purpose technologies, the kind that reshape everything, like smartphones or the internet or PCs. This isn't just some new feature for your phone. It's an entirely new layer of computational capability.
So this is a general-purpose technology, much like the internet itself. And if that's true, then the real economic value won't necessarily come from the companies building the models.
But from the innovations built on top of them.
Right.
Correct. And for you listening to this, the distinction between the AI we're used to, photo organization or traffic lights, and the current buzz around large language models, LLMs, that distinction is crucial.
Why is that?
Because what Wigdor points out is that for the first time, we have a platform that allows us to very quickly and easily train an AI. That ease of development is what enables the rapid generation of new applications. It's what defines a foundational shift.
So the foundation is solid, the technology is real, but the applications, they're just starting to emerge. And this dynamic, it creates this enormous time lag, which is where the bubble paradox starts to take shape.
That gap, that's it. The one between staggering technical potential and immediate commercial reality. That's the root cause of all the tension in the market. And Professor Arvind Narayan from Princeton, he co-authored AI Snake Oil. He gives us a framework for understanding why the truly transformative applications emerge so slowly, despite all the incredible money being thrown at the problem.
So it's not a technical failure, it's more a failure of our expectations about time.
Precisely. He details that major technological innovation doesn't happen in one sudden leap. It happens in 4 distinct stages. And critically, these stages happen on 4 different time scales.
Okay, can you walk us through those 4 stages? Because understanding where we are right now seems vital.
Absolutely. So stage one is the development of the underlying technology. You could argue we saw that with LLMs and transformer architectures from, say, 2017 to 2022.
Okay, done.
Then stage two is putting those technologies into useful products. Think of that first wave of chatbots and coding assistants.
Got it.
Stage three is early adoption by pioneering users and companies. And then finally, stage four, this is the slow one, is the broad dispersal across industries. That's where businesses have to actually restructure their entire workflows to incorporate the tech.
So if we look back at the internet, that first stage, the protocol itself, that happened way back in the early 90s. The productization phase was the dot-com boom.
Exactly. And that's why the mismatch creates such a financial hazard. Right now with AI, we're sort of stuck between stages 2 and 3. The products exist, but that deep structural industrial adoption has barely begun.
And here's where it gets really interesting because we're facing this cognitive dissonance of investing in the future today. Benedict Evans, he articulates the central paradox of this moment perfectly. He says, something can be completely transformative and a bubble, can't it?
It's not an either. That's the key. The transformative power is not in doubt among the engineers, but the speed at which that power translates into profit, that's what creates the bubble risk.
And Evans uses the perfect historical parallel to ground this for you. He reminds us that everything people were saying about the internet back in 1999, that it would transform commerce, media, communication, it was all fundamentally true.
It was.
But, as he notes, it just happened 10 years later, and for different companies. The crash was just this painful, necessary realignment between massive long-term potential and the actual short-term readiness of the market.
And that misalignment is, I think you could argue, made worse today by the language coming out of some of these leading AI labs, all that bombastic rhetoric about superintelligence.
Right.
It just amps up the short-term speculative hype among investors. Meanwhile, the practical ground-level adoption in accounting or legal work or manufacturing, the place where the real economic value gets created,
Yeah.
that takes years of careful, methodical integration.
So the foundation is solid, but the building process is slow, which makes the current frenzy look very much like premature investment, regardless of the technology's inherent genius. This tension, it leads to the central question for anyone, investing or starting a company in this space. Who is going to capture the value?
Mhm.
Right now, the apparent winners are the developers of the fundamental LLMs, the OpenAIs, the Googles. We also see companies like Cohere, which found success by carving out a really valuable niche focusing just on enterprise business applications.
But the experts, they argue the ultimate winners.
Yeah.
They might be companies that don't even exist yet.
How so?
That's the crucial historical pattern that Narayan highlights. When we look back at these foundational technologies, he says, it's not the people who invent them who are going to be the ones necessarily who are the most creative users of those technologies. The
Interesting.
most wealth, historically, is generated by the creative users coming along and building new things and building on top of it.
So to make this clear for everyone, we need to understand the stack. We're talking
Right.
about layers of technology, right?
Exactly. At the bottom, you have the fundamental models, the
Okay.
LLM builders. In the middle, you have platforms and tools, like APIs. And then at the very top, you have the end-user applications that solve specific customer problems.
Right.
And if we go back to Daniel Wigdor's investment analogy, he gives you a really clear way to think about this decision.
Okay.
Imagine investing at the dawn of the smartphone era. Should you invest in the utility provider, a telecom like AT&T, that builds the basic communication infrastructure? Or do you invest in the company that builds the killer app on top of that infrastructure, like a Facebook or a ride-sharing service?
In hindsight, that's a no-brainer. The application layer generated vastly more value than the underlying utility layer.
Which brings us to Evan's crucial technical and business question that will define the next 5 years. How far up the stack does the model go?
What does he mean by that?
This is the core economic uncertainty. Do the big foundational players, OpenAI and Google, do they aim to monopolize everything? Do they want a future where you just do everything by asking ChatGPT, which would eliminate the need for separate applications?
So if they successfully climb the stack, they become the utility and the application layer at the same time, which would justify that massive $400 billion investment.
But if the market gets unbundled into many layers of different specialized applications, which is what historical precedent suggests, then the primary value creation shifts decisively to the thousands of startups building specific niche solutions.
And Cohere's success in finding that business niche, That suggests the unbundling process is already starting.
It does. And it makes that $400 billion feel less like an investment in a monopoly and more like an extremely expensive arms race just to keep up with the state of the art.
So what could force that unbundling?
Well, one big factor is technical competition. Narayan raises a really serious issue with concentrating so much energy and capital in just one way of doing things. He means the current architecture of LLMs.
And what's the risk there? What's the alternative?
The risk is that the current approach is an intellectual dead end. For instance, if a different paradigm, something like world models, triumphs over current LLMs down the line, all that current investment could be completely misallocated.
So for you listening, what exactly is a world model and why is it a theoretical threat to the LLMs we use today?
Well, a simple way to put it is that current LLMs are incredible pattern matchers. They predict the next word in a sequence beautifully.
Right.
World models are an entirely different type of AI that aims for a deeper causal understanding. They seek to simulate how the world actually works, moving beyond pattern recognition to understanding cause and effect. If that paradigm shift happens,
Then the current LLM infrastructure becomes obsolete.
potentially, yes, that's the technical risk. But the other major competitor isn't a different architecture at all. It's the power of open source alternatives, which are closing the performance gap incredibly fast.
That feels like a huge factor.
It's a key factor driving potential decentralization. Narayan predicts that while the absolute leading models will likely remain proprietary, the property of those $400 billion giants, the open source versions will be probably just a few months behind the state of the art.
And for 90% of business applications, a few months behind is fine.
It's a negligible trade-off for zero licensing costs and full customization.
And we have a fantastic, very recent example of this in action. The Chinese company DeepSeek just released a new open source model, and it's demonstrating really high performance in areas like coding and math, performing better than some of the closed models. But the real disruptive factor is the cost.
The cost and the access. DeepSeek was cheaper to build, and critically, it runs efficiently on older, less expensive equipment than its American competitors. That changes the global economic playing field instantly.
You no longer need to be part of the $400 billion club to build a powerful application.
Not at all. It signals massive decentralization, and it validates that core argument about smaller applications winning. It just underscores what Professor Kevin Leighton Brown from UBC notes, which is that a lot of capabilities don't need the really biggest models. He goes on to point out that even the big foundational players, they don't use their super expensive model most of the time when they interact with you.
They're using smaller, cheaper ones.
They're relying on smaller, cheaper, faster models for most tasks. This means there is a huge, viable economic space for specialized, cost-effective applications built on moderately powerful or even open source LLMs.
So the most expensive models define the state of the art, but they are not the only or even the primary source of widespread commercial value.
Exactly. Hashtag tag outro.
So what does this all mean for you trying to navigate this landscape, whether as an investor or a builder? We have, as Professor Leighton Brown summarizes it, pretty strong evidence that something enormous is going on here. The technology is real, it's foundational, and it's clearly enabling things that used to be difficult or just impossible.
That much seems settled. The real knowledge gap remains around what the inevitable killer app will be and, more importantly, what the technology's inherent structural limitations are. Is it just a pure pattern matcher, or can it achieve causal reasoning? The revolution itself is not in doubt.
But the economic structure is.
The economic structure, how far up the stack the LLM giants will ultimately build, that is still very much being determined.
That is the $400 billion question indeed. We know the enormous cost of building these foundational models is the price of admission to the future. We also know that the greatest, most widespread, and maybe the most valuable innovations, they might be generated by applications built by third parties on top of those models. So given this fundamental tension, consider whether that eye-watering $400 billion investment we talked about at the beginning is ultimately a safe, long-term bet on the next utility company, a guaranteed monopoly.
No.
Or is it merely a necessary high-stakes tax being paid by the incumbents just to enable the next generation of creative billionaires?
Something to mull over as you see those valuations soar and those open source models continue to chip away at the edges. Thank you for joining us for this deep dive into the real economics of artificial intelligence.